Hi, Austin and Robert. I'd like to stay anonymous, please. I'm a new listener, but I really appreciate the transparency and wealth of knowledge you share to help us become financially sound. I want to know if I'm balancing my retirement and rental property goals in the right way. I'm 33, I work in federal law enforcement, and I make about $120,000 a year. My goal is to retire after 20 years of service at age 51. Currently, I contribute 7% to my TSP, which has about $30,000 in it. I also have a Roth IRA with $63,000 that I try to max out every year, a traditional brokerage account with $12,000, $10,000 of cryptocurrency where I dollar cost average monthly, and I have a 457B from a previous employer with $70,000 in it. On the debt side, I own a home with a 2.9% interest rate and a $1,500 a month payment. I recently bought a car with a $500 a month payment, owe about $25,000 on that at 4.5%, while also having $5,000 of credit card debt. My main goal again is to retire at 51, but I really want to get into rental properties over the next 1 to 2 years. How do I go about doing that while also balancing retirement investing? This is a really good question, and I will let Robert give our anonymous listener his first take.
Well, you definitely have your base built at 33, so we love to see that. I like the fact that you're interested in getting into real estate sooner than later, so that's good as well. And I just want to make sure you understand, though, if you're going to get into real estate in the next 1 to 2 years, make sure you're not depleting the base. We want to make sure you're thinking ahead, getting extra money set aside in a public high yield savings account or whatever vehicle you want to use to make sure that money is there, but also defining your buy box so it is within your price range and your budget range overall, because you don't want to deplete your base. You've done such a good job at 33 years old. We want to keep it that way because so many people, they build up the Roth, they build up the traditional brokerage, and then all of a sudden they have their high yield savings built up. They go buy a property and they take from all of those accounts to buy the property and they're back to zero. Because remember, investment properties, everyone should own them, but they are tying up your money for the long term and there is no liquidity. So keep that in mind, keep crushing it, but that is what I would watch out for. And that is how I would handle it. Build up another fund that is going to fulfill your needs for the buy box you've set aside for yourself to get into real estate.
So as it relates to what to prioritize next, the first thing I'd prioritize is getting rid of this $5,000 of credit card debt. Obviously, high interest debt. Can't out-invest it, no reason to keep it around. So if you have an emergency fund of 3 to 6 months of expenses, which you should have, use that money, pay off the credit card debt, and then build that emergency fund back up to that 3 to 6 months of expenses. If you don't have an emergency fund, love the idea of cashing out the $12,000 in your traditional brokerage account and the $10,000 of cryptocurrency. That's $22,000. You can use $5,000 of that to pay off this credit card debt, and then the other, whatever's left there after taxes, to start your emergency fund. Again, 3 to 6 months of expenses is where we like to be for that. Now, a couple things that you need to consider, in my opinion, as it relates to what Robert said for wanting to get into some rental properties. The first one is make sure, as what Robert said, as you begin to prioritize building up a down payment for these rental properties, that the numbers make sense to begin with. I just watched a video pretty much detailing why real estate right now just doesn't make sense. I mean, there are some people, when you think about, the median home in America is $410,000. So I'm assuming, you'll probably be somewhere around that range. If you end up doing the house hacking thing or getting one of these like duplexes or triplexes, it'd be much more than that. And you can put a lower down payment into the mix. But let's just say you are going to put 20% down on this $410,000 median home in America. That's $100,000. Pair that with about $20,000 a year of interest, another $4,000 a year of taxes, another $4,000 a year of upkeep, another $2,000 a year of insurance. I mean, you now have to really, really think about the opportunity cost of tying up well over $120,000, $30,000, $40,000, $50,000 in that first year against what that money could make in the markets, or perhaps NEOS funds, or different real estate, maybe a REIT or something on the stock exchange, or whatever else that exists out there for that passive income that I'm sure you're looking for. Now, again, real estate is one of those long-term things. So maybe you're over here thinking, hey, I don't care about the first couple of years. I care about the next 2 or 3 decades. I'm only 33. I want to retire by 51. So I'm looking at this as a 2-decade play, which very well could make sense and could make a lot of money by then. You just got to make sure you run those numbers and you're not shooting yourself in the foot. Now, whenever you think about how do I now save for this down payment, you want to invest up to the match. And you want to make sure to get the free money, right? And you want to make sure you're maxing out the Roth IRA. Those are the bare minimum things you need to be doing. Any money above that, needs to go be set aside for this down payment or invested or something so it can grow for the next 2, 3, 4, 5 years as you sort of save for a large down payment there. Call it 5, 10, 15, 20%, depending on how much you want to buy. Tens of thousands of dollars is likely what that will be, right? Make sure you don't stop the Roth IRA and you don't stop getting the free money, but everything above that, save for it. And that's how you should be saving for it.
I love this breakdown, Austin. And the only thing I'm going to click back with is start small. So many people think they need to go out and buy some big fancy property. I do it in Ohio all the time. There are homes in Ohio for under $100,000 that make great rental properties. You can go in and buy them for $80,000, put $30,000 into them, rent them for $1,200, $1,300 a month. So just make sure, like I said and Austin alluded to, know your buy box, stick within your buy box, and prepare ahead of time so you don't deplete any of the retirement accounts.